Today's market moves weren't just about price action, they reflected a deeper shift in how investors are thinking about inflation, policy, and geopolitical risk all at once. What we saw on the surface looked mixed. The Nasdaq moved higher, supported by technology. The S&P 500 was slightly positive, but the Dow declined, showing weakness in more traditional, economically sensitive sectors. At the same time, something much more important was happening beneath equities. Bond yields surged sharply. The US 10-year yield jumped in a way that doesn't usually happen without a meaningful shift in expectations. And commodities told a very clear story. Oil spiked more than 8%, while gold actually declined. So this wasn't a clean risk-on environment. It was a market adjusting, quickly, to a new set of assumptions. What changed those assumptions was a combination of geopolitical tension and policy uncertainty. On the geopolitical side, rising concerns around global oil supply, particularly linked to tensions involving Iran and the Strait of Hormuz, pushed crude prices sharply higher. And that matters because oil is not just a commodity, it feeds directly into inflation expectations. When oil moves this aggressively, markets start to question whether inflation will stay elevated longer than expected. At the same time, investors were already reassessing the Federal Reserve's path. Stronger economic signals combined with persistent inflation concerns forced markets to pull back expectations for rate cuts. So you had two forces hitting at once: higher oil prices pushing inflation fears up, and a policy outlook suggesting rates may stay higher for longer. That combination is what drove the sharp move in yields. From there, capital started to reposition, but not in a broad or confident way. Instead, flows became very selective. Money moved into energy, which benefits directly from higher oil prices and acts as an inflation hedge. At the same time, large-cap technology continued to attract capital, not because conditions are easy, but because these companies are structurally strong, cash-rich, and tied to long-term themes like AI. But outside of those two areas, the picture was weaker. Utilities, real estate, and healthcare all declined. High-yield credit softened. Bitcoin fell, and the US dollar strengthened, pulling liquidity toward itself. So what you're really seeing is a kind of barbell behavior. On one side, inflation hedges, like energy. On the other, concentrated growth in big tech. Everything in the middle is being reduced. That leads to an important question investors are debating right now. Is this a stable positioning shift or the early stages of a broader repricing across markets? I'd be interested to hear how you see this, whether this looks contained or something more structural is developing. Because under the surface, there are signs of fragility building. The first is in the bond market. A move of this size in yields suggests that positioning may have been offside, and when that happens, it can lead to forced adjustments. The second is in credit. High-yield bonds weakened even without a major equity sell-off. That's often an early signal that financial conditions are tightening more than equities are reflecting. The third is market concentration. Tech is holding up, but leadership is narrow, and when only a few areas carry the market, stability becomes more fragile. And finally, there's the inflation signal itself. Oil rising while gold falls suggests that markets are not fully aligned on how inflation will evolve, which increases the risk of mispricing. So what does all of this mean at a macro level? It suggests that markets are beginning to accept a more difficult environment, one where inflation is not fully under control and where interest rates may stay elevated longer than previously expected. At the same time, growth is not collapsing, but it's becoming more selective and concentrated. That creates tension, because higher yields increase the cost of capital, and eventually, that pressure can extend beyond rate-sensitive sectors into broader equities. Looking ahead, the next phase will depend on whether today's shift holds or reverses. Investors will be watching inflation data closely, especially CPI and PCE, to see if the oil-driven narrative is confirmed. Labor market data will also matter. A strong jobs market would reinforce the idea of higher for longer rates. And importantly, major technology earnings will be tested because if yields remain elevated, the question becomes whether those valuations can continue to hold. At the same time, any signals from the Federal Reserve, especially during this leadership transition, could either stabilize or further unsettle rate expectations. The broader takeaway from today's market reaction is that investors are trying to price persistent inflation without breaking growth. But that balance is fragile. Rising yields don't just affect one part of the market, they gradually tighten conditions across the system. And what we're starting to see is early evidence of that pressure building. Markets rarely move on a single narrative, so I'd be interested to hear how you interpret today's signals. If you find this kind of calm, analytical breakdown useful, consider subscribing. I share regular briefings focused on the deeper forces shaping market behavior. And as always, thank you for spending a few minutes here.